Hi everyone, welcome to a brand new episode. I'm Marcus and today we're looking at StarBUX, ticker symbol SBUX. We'll cover the income statement, balance sheet, cash flow, key figures, our key feature, and the technical aspect of the stock. StarBUX have been hit hard and the share price dropped more than 30%. So should we be buying the stock? Well, let's find out. StarBUX is among the top roaster marketers and retailers of specialty coffee in the world, operating in 84 markets. What they do is that they purchase and roast high quality coffee and that they then sell along with handcrafted coffee, tea, and other beverages in a variety of food items through company-operated stores. They also earn revenue through licensed stores. One of their strategies is the opening of new stores both in existing and developed markets. They also create new consumer offerings in the form of coffee and other products in a variety of forms across new categories. They also work to attract investors through disciplined capital allocation methods such as prioritizing high return investment, share buybacks, and competitive dividends. StarBUX operates in three segments. The first one being in North America, and which is US and Canada. The second one being the international market, which consists of the following: China, Japan, Asia Pacific, Europe, Middle East, Africa, Latin America, and the Caribbean. The third one being their channel development, which is non-reportable operating segments. The North American market is 70% of the company's revenue, and the international market coming in at 24%, and lastly the channel development making 6% of the total revenue. If we look at the distribution between company-operated stores and licensed stores, we can see that there is not a huge gap between those two. The company had of October 3rd, 2021, 17,133 company-operated stores and 16,700 licensed stores. But what is important to know is that the company-operated stores accounted for 85% of total net revenues during fiscal 2021. If we take a closer look at the company-operated stores, we can see that as of October 3rd, 2021, the company had most of their stores in the US with 8,941 stores, and China being the largest international market with 4,704 stores. So why are people buying from StarBUX? Well, the company believes that their customers choose them primarily on the basis of product, quality, brand reputation, service, convenience, and price, but they experience direct competition from large competitors in the quick service restaurant sectors and from the ready-to-drink coffee beverage market, as well as well-established and startup companies. So what's in the news? Well, StarBUX founder Mr. Howard Schultz have returned as CEO, and this will be his third time being CEO of StarBUX. A lot of people have high expectations on Mr. Schultz, as it was under his leadership that made StarBUX to an international success, expanding from 11 stores to 28,000 in 77 markets around the world. And he have announced that StarBUX are suspending their stock repurchase program in order to invest more in their employees and their stores, and Wall Street did not respond well to this news, sending the stock price lower levels, and as of today gone down more than 30%. The return of the former CEO could fuel new energy as the company has to face the challenges of inflation, increasing supplier prices, wages, as well as unionization push among US baristas. Now, with that said, let's look at the numbers. So StarBUX is traded on NASDAQ and are in the trade and service sector. If we go down to the screen, we can see that their market capitalization coming in at $91.8 billion and the revenues at $30.4 billion. PE ratio coming in at 21.5. Normally I like companies with a PE ratio of 20 or below, so having 21.5, I understand it's not far from the threshold. You want to be flexible, I get it, but for me that is too high, so that is a no for me. As always, guys, when you see a stock with a high PE ratio, what does it tell us? Well, it tells us that the market expectation of that stock is high, and therefore there are good chance that you might see capital gains on those stocks because there's a lot of investors pushing the price even higher because they are expecting better and better numbers. But as we have seen with Netflix, PayPal, and many more companies, is that if the company cannot meet those expectations, we will see the stock price fall. Same thing goes when you see a stock with a low PE ratio. That tells you that the market expectation of that stock is low, and therefore you might not see capital gains on those stocks. Just keep that in mind. Now, profit margin coming in at 14.5%. Normally, I like companies with a profit margin of 15% or higher. So coming in at 14.5, I understand it's not far from the threshold, but it's lower than what I normally like to take a look at. So that is no. But I understand it's not far from the threshold. You could be flexible here, but for me, that is a no. So price to sales ratio coming in at 3. Normally, I like companies with a price to sales ratio of maximum 4. So coming in at 3, that is a good to go. So that is a good. So we don't have any price to book value data, but if we summarize, PE ratio is too high, price to sales ratio is within my range, but that makes it still overvalued because of the PE ratio. So they pay out a stock of $1.88. I like it because I like those recurrent income. Now, the effective return at 2.4%. I like it. I would like to see a range at least at 2.53%, but higher numbers are welcome. But at the same time, guys, I want you to be very cautious because there are stocks out there with a much higher effective return. Take, for instance, AT&T, which is around 5%. Which is great. Those are great numbers as long as you hold those stock and get a good return on your capital. But when it comes time for you to exit the stock, you might not get a higher price than what you bought it for. And AT&T, example of that company, we're seeing the stock price getting lower and lower right now. But if we zoom out within a larger frame, we can see that the stock have been consolidating. So you just have to keep that in mind when you see a stock with a high return. You have to ask yourself, okay, is this stock consolidating? Is it moving within a negative trend channel or a positive trend channel? And what is my exit strategy? Will I get a higher price than what I bought it for when it comes time for me to sell? So you need to ask yourself that. So seeing a return on 2.4, that is acceptable. So that is a goal for me. So we don't have any return on equity data, but return on equity tells you about a company's ability to create return on their equity. And as for investor, it tells you about the company's ability to create a return on the capital you're about to invest in them. Return on asset coming in at 10.5%. I like it. So that is a goal for me. So the stock is currently traded at $81 per share. If we go down to the moving average, we can see that we are below the 50-day moving average and below the 200-day moving average. So this is a clear signal. The indicator is telling us that we might see the stock price decline. But if we take a quick glance on the chart, we can see that we have been more or less consolidating for quite some time, but as of lately broke down below that channel and have now been moving in a negative trend channel. But we'll take a closer look at the technical aspect of the stock further down. But let's jump over to the income statement. And what we can see here is that the total revenue went from $22.4 billion up to $29.1 billion. And these numbers have been improving. We fell off a bit in 2020, but overall trend is positive. I like that. Gross profit went from $10.3 billion down to $8.4 billion. Improved a bit a couple of years, but as of lately seen a lower and lower level. So is this a counter trend we're seeing here and seeing that these numbers are declining? So that is a negative. Net income went from $2.9 billion up to $4.2 billion, and we can see that these numbers have been improving. Fell off a bit in 2019 and 2020, but have since seen better and better numbers. So this is a plus. Now let's jump over to the balance sheet. What we're interested here is that the current assets versus the current liabilities, and we can see that there is a huge difference between the current assets and the current liabilities, which is a plus. Basically what this is telling us is that if the company were to convert the current assets to cash, they're able to pay off the current liabilities, and that is amazing. But they are far from being able to pay off the total liabilities, and that is negative. If we take a look at the total liabilities, we can see that it went from $8.9 billion and then it made a huge jump to $23 billion, and these numbers have since been getting higher levels, and they reduced it a bit in 2021, but overall trend we are seeing that these numbers are growing, so that is negative. I would like to see them reduce their total liabilities and also reduce the rate which is growing, so that is negative. Let's jump over to the outstanding share. We can see it went from $1.4 billion down to $1.2 billion, and we can see over the last 5 years we're seeing lower and lower levels, so this is a plus. So basically what is happening here, when we see that these numbers decrease, that means that the company is doing buybacks, meaning that there are fewer and fewer available shares out there, making your share of the companies grow, expand. But if we were to see these numbers increase, that would mean that the company is issuing more and more shares, meaning that there are more and more available shares out there, meaning that your share of the company is decreasing, meaning that you're being diluted as an investor. And I've said it many times that there's a lot of investors that either skip this part or doesn't know about it, because they've been looking at a company's balance sheet and they see this company has a strong balance sheet. They have a lot of assets and the debt is not growing that much. But on the other hand, we can see that the company is issuing more and more share, because that is a way for a company to bring in more capital without taking on more debt. So keep in mind, when you see a balance sheet, don't just look at the assets and the debt. Make sure you also look at the numbers of outstanding shares, and see that these numbers are decreasing, even though they haven't decreased a lot over the past 5 years, but still they're doing buybacks, so that is a plus. Now let's jump over to the cash flow, and what we are interested in here is that the operating cash flow versus the capital expenditure. We can see that operating cash flow came in at $6 billion and the capital expenditure at $1.5 billion, making it a difference of $4.5 billion. That is amazing. Now the operating cash flow went from $4.3 billion up to $6 billion, and these numbers have been improving, and then we fell off a couple of years and then improved again, so that is a plus. Capital expenditure, a bit of fluctuation, but it has more or less remained the same, around $1.5 billion. That is a plus. I like the fact that they continue to invest in the business. Now let's jump over to the key figures. What we can see here is that the earnings per share went from $2 up to $3.5 per share, and these numbers have been improving. We fell off a bit a couple of years, but have since seen better numbers, so that is a plus. Revenue per share went from $15.6 per share up to $24.6 per share, and these numbers have been improving. We fell off a bit in 2020, but overall trend is positive. That is a plus. Equity per share went from $3.8 per share down to negative $4.5 per share, and these numbers have been falling. This is negative. Dividend share went from $1 per share up to $1.8 per share, and these numbers have been growing every year. I like it because I like those recurrent income. Also the fact that the income is growing every year, so that is a plus. Dividend share, we see here a bit of fluctuation, 50%, 38, 48, 200, too much, 50%. So I liked it. I like this because I like companies that pays out less than 60% of the capital, because I want some of the capital to remain in the business for investments, acquisition, and just having the capital to sustain the business for uncertainties. So that is a plus. Gross margin went from 46% down to 28.7%. A bit of fluctuation, 44, 54, 58, and then we fell off a bit. So seeing that these numbers have been improving, that is a plus. But also, I don't like fluctuation. I would like to see a more stable numbers, but we need to compare these numbers across the industry and see how is the company doing compared to their competitors. But overall, I like the numbers. These are still high numbers, but I would like to see a more stable development. So this is positive. Operating margin went from 19% down to 18.4%, and we can see that they have been improving, and then we fell off a bit and improved again over the last 5 years. So that is a plus that they did a comeback there. Profit margin went from 12.8% down to 14.4%, and we can see they improved a bit, but have since in lower and lower numbers, and then improved it in 2021. So that is a plus. Return on equity went from 52.9% down to negative 78.9%. That is negative. We can see they improved a bit, but have since seen lower and lower numbers. So this is negative. Basically, return on equity, as I mentioned, tells you about a company's ability to create return on their equity. And as for investor, you want to make sure you have a company with a positive return on equity, because that means that they are able to create return on the capital you're about to invest in them. So seeing these numbers, that is a no for me. Return on asset went from 20% down to 13.3%, and we can see that these numbers have been more or less falling every year, so that is a negative. So I don't like that at all. Solidity tells you about a company's financial strength for the long term, and seeing that they went from 37.9% down to negative 16.9%, and these numbers have been going lower and lower, so that is negative. Balance sheet liquidity, same thing as solidity, but here it looks at the financial strength for the short term, and we can see it went from 1.3 down to 0.35, and these numbers improved a bit, but have seen lower and lower numbers, improved a bit, but overall trend is negative. Debt ratio went from 1.6 down to negative 6.9, and they increased the debt, but have seen lower and lower numbers. This is a plus. Basically, in 2021 they had a debt ratio negative 6.9, meaning that they had 6.9 times more equity than debt in the business, and that is a plus. So guys, we have gone through the income statement, balance sheet, cash flow, the key figures. Now over to our key features, which is the stock analyzer. And what the stock analyzer does is that it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers, or have the software do the heavy lifting for you. If we take a look at the screen, we can see that the PE ratio is above 20, which is negative. The company pays out a dividend, which is a plus. Dividend payout share less than 60% plus. Dividend increased over the past 5 years, that is a plus. And the numbers of outstanding share have decreased over the past 5 years, that is a plus. Revenue increased over the past 5 years, that is a plus. Profit margin below 15%, that is negative. Profit decreased over the past 5 years, that is negative. And the current assets is greater than liabilities. Current liability, that is a plus. And the solidity decreased over the past 5 years, negative. Balance sheet liquidity decreased over the past 5 years, negative. Debt equity ratio improved over the past 5 years, that is positive. And the total liabilities have grown over the past 5 years, negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers, or have the software do the heavy lifting for you. And you can have this software along with everything we've gone through, plus access to our discussion forum, where you'll be able to chat with me along with other members for only $10 per month. So make sure to head over to comments.sc and become a member today. Okay guys, thank you. But now let's look at the technical aspect of the stock. So here we have the chart. As you guys can tell, we have been for many years now been moving in a positive trend channel, and this trend is still continued going strong, but as of lately seen that the stock price fell off rapidly, more than 30%, and is down to $80 or $81 per share. So we are currently right here at a critical area right here. As you can tell, we have, this is key area we are currently at. So there will be a lot of investor looking at this and seeing, is this a potential buy? What would happen here? Because if we were to buy here and the support line holds, we could see a move upwards, something like this. So that would mean that we could see a move of 50% over a couple of years, I believe. But 50% development, that is great. Also during that time earn both capital gains but also dividend. That would be amazing. But still, the company has a lot of challenges, so we could see that the stock price breaks below these areas and then comes back up again to do a retest. And if we see that the price breaks below this area, then we know that we'll see a continuation downwards here. But I believe there will be a lot of investors, a lot of people participating right here. And also I believe depending on how you view the company, that there is a great opportunity to enter the stock for a move, something like this. Or we could see, based on the inflation rate, interest rates that are growing, and the challenges the company are facing, and also that the way the economy is moving right now, that we could see that the stock price breaks below these areas. But I believe that there will be a lot of people buying the stock and pushing the price even higher. So that's what I would do. So if I were to summarize my thoughts of the company, seeing that the stock price is down to $81 per share, it makes me want to buy the stock because it is at the support line right now, which is a key area. And if the buyers come back and push the price higher, we could see a potential move of approximately 50% over a longer period. But at the same time, the company is facing higher prices, higher interest rates, the unionization push from the employees, and also the fact that they are cutting their share buyback program. But I do like the fact that they will focus on their baristas and their stores, which I believe can have a positive impact on their bottom line. But looking at their numbers, I do like the fact that they pay out dividends, and the dividends are growing every year. But having a payout rate at 50% of that capital is quite high, and there's not a lot of leg room left for increases, because I like company that maintains a healthy level. I will also accept that they lower the payout share to between 20 to 30%, so the company could invest in being efficient, improve their margins, reduce their debt, and improve their financial strength, because these numbers need to improve. So I'm happy that they are cutting their buyback program, because I believe in the long run this will have a positive impact on the business. And if they could improve their financials, that would make them a very attractive company to own. So the question we're all asking ourselves, should we be buying? I'm actually interested in buying, even though it comes with a risk. If I would score the company, I would give them a score of 58%. So that's how I would trade the stock. How would you trade the stock? Please let me know in the comment section below. And also let me know if you have any questions or have stocks you want me to look at. And as always, please do your own analysis. Thank you so much for watching. I am truly grateful and I appreciate it. And if you haven't enjoyed this episode, please give me a thumbs up, comment, subscribe. And until next time, guys, take care. Bye-bye.